Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to the Wall Street Lab podcast. This is the second part of a two-part interview I had with Mark Yusko, the CEO and Chief Investment Officer of Morgan Creek. If you like what you hear, as always, make sure to leave a 5-star review on iTunes as it really helps us grow the show. And without further ado, please enjoy the second part of our conversation with Mark Yusko. One thing that we sometimes talk about internally is that you meet with so many extremely bright people in this business. You know, every pitch deck you look at, you have people from the best universities, have worked at the best companies with the best training. And sometimes you come across someone that you clearly see that they're really smart. They have all those attributes that you've just mentioned. But you then ask yourself whether that person would be a good manager of people, especially if it's a young manager starting a new company. So how much weight do you put in a high-quality investor versus a high-quality people manager?
Yeah, you just have the best questions. I could talk all day. No,
I hope you have all day. I do.
No, it's just great. It's because, again, no one asked this question. I call it the no jerk rule. I have a more flamboyant word for it, but we'll call it the no jerk rule for now. The thing is, there's so many examples of people, as you say, they have the perfect pedigree. They went to the perfect school. They excelled at the firm they work for. They work for Goldman Sachs or Morgan Stanley or Bridgewater or whatever. And they made it through all the screens, but they're just a jerk. And nobody wants to work for them. Nobody wants to be their partner. And inevitably, they're going to blow up and fail. And I've only violated this twice in my whole career. And both cases, it didn't work. No surprise. And you said, well, why'd you violate your process? In the first case, it was this guy. He was ex-Morgan Stanley. He was the king of fixed income. I mean, everybody loved this guy. I had invested with his brother at a different hedge fund. And every check I did on him said, the guy's just a narcissistic jerk. But everybody was like, no, you got to do it. He's just such a moneymaker. He's a moneymaker. Well, he was a moneymaker until it got hard. And then he blew up. And that was just a mistake. So I do think that what your question hits at is what's more important than intelligence and intellect and good pedigree and good references and good relationships is people who have a good moral compass, who have a good moral center. And I'll give you an example. So my wife and I got involved with this scholarship program back at Notre Dame. And we interviewed these kids. And in the first year we were interviewing, and there was this young woman. And one of the interviewers summed it up best. He said, that woman is going to be amazing leader someday, but I'm not following her. That's exactly it, right? Is the great ones are, Julian Robertson's a great example, right? Julian, if you look at the people who used to work for Julian, they managed 10% of the long short money in the world. That's incredible. Mm-hmm. Now, how did he do it? Well, one, he was, I think, the greatest identifier of talent our business has ever seen. Well, how did he do it? Well, he just had a knack, he had an edge at sitting down with people and understanding who was not only smart, but who had the ability, again, to explain ideas simply, who other people would like and want to work with. And he was amazing in that capacity. And there are other people who have done the same thing. The inverse, I'll give you an example. So there's this famous soccer coach at North Carolina called Anson Dorrance. And Anson basically beat every record you can have for winning national championships. His soccer teams have won, I think, 21 or 22 out of the 28 possible national championships. I mean, just crazy success. And he tells this great story about he recruited the best player in the country to join the team, and they're playing their first game, and they're down 2-0 at halftime. And North Carolina women's soccer team was never down 2-0 at halftime. And he get in the locker room and he's talking to the other young women and he says, what's going on? Brittany, and I don't remember, that wasn't her name, but Brittany's, wide open. Why don't you guys pass her the ball? And the two other players turned to him and said, we hate her. What are you talking about? She's the best player. She says, we don't care. We hate her. We'd rather lose than give her the ball. And like, oh my God, and particularly guys can't imagine that, right? It's like, it's about winning and who cares if he's a jerk? Well, no. And teams, I think, are what really make great investment firms. Whereas I think the opposite is true in investment committees. There's the great line that investment committee should be an odd number and 3 is too many. So, because groups ultimately make bad decisions, but good teams where there's a leader, a portfolio manager, but a team around them to do the research and build the ideas, they have to work well together and they have to be able to pass each other the ball.
So my follow-up question, I have so many, Mark, so many good points that you touched. The first one is, so imagine you've done your diligence, you've picked the manager that you think will succeed, and then a couple of years have passed and it hasn't performed. At what point do you accept that you have made a mistake? At what point do you decide to pull the plug?
Again, for us, there has to be a change in the people, process, or philosophy. If the performance is bad, that's never enough, because there are a lot of reasons performance can be bad, right? We could have chased momentum and we could have hired somebody at their peak and peak alpha. And this has happened to us, many times in the past where, we just loved somebody and it just turned out we hired them on a peak of alpha. They're just generating huge amounts of alpha, and alpha is mean reverting, right? You're not going to be good all the time. And so, they may lag in performance for a couple of years, but as long as the people, process, and philosophy haven't changed, we won't change. Now, if something has changed, people, process, or philosophy, we won't wait a minute to terminate, even if performance is really good. Now, one thing you bring up, which is interesting, is what if you made a mistake? Right? What if you analyze the people, process, and philosophy, and you just made an error, and now you've got bad performance, and you don't think anything's changed, but you just made a mistake, and so you can't see it. That one's tough. And I think one of the things that separates really good investors from the great investors is the great investors are very quick to recognize their mistakes. And George Soros has this great line. He says, I'm only rich because I admit my mistakes faster than other people. Mm-hmm. And the really, really great ones have an uncanny ability to double up. So they never double down. There's a great picture of Paul Tudor Jones at his desk in college, and there's a sign that says, losers average losers. And it's true. Most people, when they make an investment, like say they hire a manager and it goes down, their natural inclination is to give them more money to try to average down their cost. That's the worst thing you can do, right? Because you're compounding the mistake. Same thing with an individual position, right? If you buy a stock and it goes against you, right, the market's telling you that, either you made a mistake or something wrong. Now, if you've done the work and you really have conviction that you have done everything right, and then maybe as a value person, if the margin of safety was there, maybe you could argue that is a time when you should buy more. But my historical experience is that most times when the market's telling you you've made a mistake, you have. And so that performance, you have to react. Now, that goes counter to what I said earlier, which is, hey, as long as the people, process, and philosophy haven't changed, you got to tough it out on the performance side. But I do think that when we think about this issue of making mistakes or how do you admit when you're wrong or how do you double up when you're right, I think it really does come down to conviction. Mm-hmm. And most people don't do the proper amount of work to get the proper level of conviction to hold through temporary periods of volatility. Because every investment we make, we're going to have periods of volatility, whether we're just early. That happens to me all the time. I'm notoriously early because I'm a value investor at heart, and I like to buy things that are on sale, and sometimes they go more on sale. Mm-hmm. But as long as you've done the work and you have the conviction and you believe you have the margin of safety, then feel comfortable buying additional, value assets. The challenge is, when is early the euphemism for wrong? Mm-hmm. And it certainly can be. And that, I think you've hit on something that I said we could talk for a long time about. It's really the art versus the science. Mm-hmm. Science would say, well, there should be some quantitative rule like a stop loss. If I'm down 15%, I'm out. Stop losses don't really work in my experience. What does work is a constant re-underwriting of the reasons that you made the investment decision. So if you hire a manager, why did you hire them? You hired them because you had confidence in the team, you had confidence in the philosophy, you had confidence in the process. So go back and re-underwrite. Is the team the same? That doesn't just mean are all the members still there? Because remember, teams can change, right? Someone could get rich, someone could be going through a divorce, some other personal tragedy. I mean, I've had every imaginable experience from people who've lost kids, and that clearly impacts your ability to focus on your job, to people who've gone through nasty divorces. I've had this experience where the guy kept me waiting in his office, where I was meeting with his architect. Like, okay, I'm out. He's too busy working on his second house or his collection of 19 Porsches. I got better things to do with my capital. So that's a long, rambling answer to what is a really critical and important question, which is how do you separate early from wrong? How do you separate just plain wrong, right? You just made a mistake. And how do you keep that solid focus on, re-underwriting your own process, having a discipline and sticking to it, and making sure that you don't make excuses for why things aren't going your way.
And I think this is a good segue to another interesting and important topic that you've talked about in the past, which is portfolio construction. So you talked about re-underwriting and maybe not buying at the bottom and not selling at the peak, and conviction. So how do you weight your positions and managers and stocks if you do internal management at Morgan Creek?
Yeah.
Do you weight it based on your amount of conviction? You have a set number for specific asset classes? How do you think about that?
Yeah, look, this is such an important topic. So let's break it down from asset class down to manager and then into individual securities. So at the asset class level, historically, if you read Swenson's book or talked to David Salem or others, they would say that you have a strategic target for every asset class. You have a tactical range around that asset class. And the only thing you should do is you should rebalance back to your strategic target. Because if you move away from the target, that's a speculation. So let's say you have a 50% target to equities and you go to 60, that is a speculation. If you go from 60 back to 50, that's a rebalance. Rebalancing good, speculation bad. I'll argue a little differently on that, which is to say that while I used to be much more about specific strategic targets and tactical ranges and disciplined rebalancing, what I have come to appreciate, and I actually learned this from working with a lot of families over the years, particularly multi-generational families of big wealth, is they were much more tolerant of individual positions growing bigger and riding their winners. And when I had the epiphany on this was I've had the benefit of working with just about everybody who spun out of Julian Robertson's shop. And I would take these copious notes when I talked to him about, what made Julian such a great investor. And every single one of them said the same thing. They said, he had this uncanny ability to double up and to let the winners run. And I think that's one thing I've become much more tolerant of is when you do get conviction on an idea and it's working, is to really let it run. And Stan Druckenmiller has a quote about that, and it's appropriate this year. And, we're in the year of the pig. And he says, when you have really high conviction or you get an edge in something, you have to have the courage to be a pig. And you go back to the experiences he had with Soros, and they made all their big money when they got that edge and they took really big positions. So I've come around to that way of thinking that an asset allocation, it's okay when you get an edge, whether it be on a currency or a stock or, stock segment like technology or healthcare or international, China or something like that, geographic, where you get edge and you put the pedal to the metal in a specific area. When it comes to manager selection, there are two ways to think about it. There's portfolio construction that says, okay, if I'm going to have 10 managers, I'm going to give them 5% each. Then there's the other that says, well, no, I'm going to give 50% to one and 5% to the others. Well, that's tougher because there actually is a lot of research now on conviction weighting versus equal weighting. And the data actually supports that equal weighting works better because conviction weighting, we tend to fool ourselves, right? We tend to believe our own BS, and we think that we are better than we probably are at having those convictions. And so equal weighting looks like it has a little better outcome. And we found this out in, we have a process internally where we run a hybrid fund. So we have a fund where we started off as a fund of funds and we allocated to external managers. And then we brought the process 6 years ago internal. So we did what Soros used to do, where he would supersize the best ideas of the underlying managers. So now we run about 50-50. And that internal portfolio, we started with a little more conviction weighting, thinking we had insight because we talk to the managers and get these special insights. And it turns out equal weighting works way better. Mm-hmm. So now we just supersize the best ideas equally, and we do let them run to a point, and we rebalance quarterly. So we don't trade a lot. That was another thing that added a lot of value. Was there's this great paper by Terry O'Dean at Berkeley years ago that studied men and women brokerage accounts, and it showed that the women outperformed the men by a dramatic margin. It was for 3 reasons. The women only invest what they understand and they know, whereas guys think they know about everything, so they invest in things they don't understand. Second is they overtraded. Guys overtrade and the women didn't overtrade. And the third is they were very patient in how they allocated their capital, as opposed to guys, again, feeling that activity, everything had to be active. And so they're actually one of the best book I've ever read on investing is called The Dow Jones Averages, and Dow is spelled T-A-O. And it's a mixing of ancient Chinese philosophy and investing. And it talks about this idea of whole-brained investing, about balancing the analytical approach that most guys use and the more intuitive approach. That's why they call it women's intuition. Mm-hmm. And this balanced approach in how you think about portfolio construction and portfolio rebalancing, portfolio allocation. So there's that intuitive piece, which is, when ideas are working or when managers really feel right. And if you intuitively follow that gut instinct, there's something to be said for that having a value add. In fact, Michael Steinhardt said that, trusting your intuition or your gut is really important because it's like a supercomputer that's always on in your subconscious. And it's like that eureka moment you have when you get up in the morning, you get in the shower, and all of a sudden you remember or have this insight. Well, it's because your subconscious is working on it all night. It's not that you're smarter in the morning. It's just that your subconscious actually never turns off. So sometimes trusting that gut instinct, that intuition, and letting that equal weighting migrate is okay. But generally speaking, we've tended to err now on more equal weighting on the portfolio construction. And then when it comes to individual positions as well.
So we talked a little bit about asset allocation, manager selection, and portfolio construction. So for someone who is not in this business, who is listening to this right now, it sounds extremely complicated and complex. So what I wanted to ask you as the CEO and CIO of Morgan Creek, and I'm assuming you hire a lot of people every year. Let's say one of your children decides to tell you, hey, I want to get into the business, Dad, and what would be the best way to learn this? So what sort of training would you put them through?
I love this question. I'll also tell you a funny story before I give you the question. So I have a unique family. I have 2 older kids, 30 and 28. My daughter's a nurse practitioner. My son works in tech. And I have an 8-year-old. And my 8-year-old, we were talking the other day, and he has had a babysitter since he was, 5 weeks old, who spoke in Spanish. So he's bilingual. I'm not. And in order to, help him with his Spanish, I have to use Google Translate. So I'll say a phrase into the computer and then spit it out. And I'll say, how do you say it? So I'll say, for dinner tonight, we had chicken and rice, and it'll spit out the word. And I'll say, okay, well, how do you say that? And he'll tell me. And so I talked to the phone and I said, when I grow up, I want to be a fireman. And he says, no, Dad, I want your job. I want to be the president of Morgan Creek. And I'm like, okay, I'll play this game. So what we do is we try to figure out what people are going to buy in the future, and we try to buy before other people do. So what would you buy? And without missing a beat, he says, computers with holograms. I'm like, all right, I'm retiring. You got my job. 8 years old. You're in charge. But I tell that story to answer your question, which is, what should people study? So for me, investing is all about intellectual curiosity, creativity, and this scientific background. So I think liberal arts is a great form of study. So, learning how to learn. I think history is really important because history tends to rhyme. It may not repeat, but it rhymes. And investing is pretty cyclical. So there are these cycles that recreate over time. So having an understanding of history is important. I do think science training is really important. And ultimately, I'll argue that investing is much more simple than most people make it. And so people who have the ability to take complex ideas and keep them simple and describe them simply and think about them simply and break them down into their most simple parts have a huge advantage. So for people who are thinking about, wanting to go into investing, I think you want to spend a lot of time reading history, reading about science and technology, because so much of what we do is really about investing. As I said to my son, we want to buy things today before most people understand and believe them. So I would say, and this is my pinned tweet on my Twitter account, is you make the very most money in investing when you buy something that you believe in before other people even understand it. And so if you can spend time really deeply understanding certain trends or certain areas, and it doesn't have to be, the most super complex technology. It could just be retail trends or consumer trends or demographic trends. Just think about every day, 10,000 people in the U.S. turn 65. Every single day for the next 17 years, 10,000 people in Europe will turn 65. So pretty much anything that caters to 65 to 85-year-olds is going to have a tailwind. So you can think about that in simple ways, like what are people going to pay for? What are they going to pay to look better? So that probably explains that purchase of the Botox company the other day. Mm-hmm. They're going to pay to feel better. So probably pharmaceuticals. They're going to pay to have experiences. So travel and leisure and cruises and things like that are probably going to be interesting. Now, what's going to struggle? Well, McMansions are probably going to struggle. Mm-hmm. So people who built big houses in the suburbs, as people downsize and move back to urban environments, probably going to be some short side opportunities. So taking just simple observations, but from big trends. And so another book that I like that gave me a fundamental construct for the way I think about investing was Harry Dent's first book called The Great Boom Ahead. Now, many of his other books people don't like, and I'm probably in that camp too, but his very first book called The Great Boom Ahead from 1994 was amazing in how it described S-curves. And every technology has this S-curve adoption, right? The innovators and the early adopters and then the early majority. And then there's this knee of the curve into the majority and the late majority before you get to maturity. And understanding how these S-curves align and work really gives you an edge as an investor. So again, that's a long rambling idea of if you're not in investing, but you have an interest in investing, it's really not as complex as people say. And people who speak in jargon and who sound really complex run away, far away. And you should give your capital to people who say, look, this is a simple game. I can explain it to you in simple terms, and I can make you comfortable with the idea that it's about history. It's about how to think, being open to creative solutions to new ideas, to old problems with new ideas, and the age-old thing about, think outside the box. I always say occasionally think like there is no box. And one last piece of reading homework is there's a great essay by a guy named William Deresiewicz, and it's called Solitude and Leadership. And it talks about the power of solitude, about being alone, being quiet and still, and actually, spending time to think. I think that's a really important aspect of great investors is they spend time thinking their own thoughts as opposed to just, repeating other people's thoughts.
This is a great segue to my next question, Mark. And I wanted to ask you about your writing, because You put a lot of information out there, and it looks like you're an avid reader. You spend a lot of time reading and thinking and also writing. And also you have a business to run, portfolios to run. So how do you prioritize that? I mean, it sounds like you have more than 24 hours a day.
The writing is really funny because I started doing these letters many years ago. They were shorter and they've grown in length over the years. And part of it is, I get all this grief from other guys in the company, or, we had a PR firm, and they say, you can't release these long form letters. I said, why not? I said, well, people don't want to read them. I said, they're not for other people. They're for me. I said, what are you talking about? I said, look, it's how I think. And there's a great line, I don't remember who said it, one of the authors, he said, if I can't read what I wrote, how do I know what I think? Mm-hmm. And so my writing process really is about synthesizing information. And this goes back, to one of your earlier questions again, which is a fundamental key to investing, which is in the early days of investing, it was all about access to information. And if you had access to information better and faster, then you could be a better investor. But those days are gone, right? Information is ubiquitous. We're drowning in information. We got way too much. In fact, what we're starved for is knowledge and wisdom. And how you get that is from synthesis. And synthesis can only occur if you spend time with the data and spend time with information and spend time with history and spend time with philosophy and really put all these things together and spend time with people who are innovating and creating new technology. And so it's not that I have more than 24 hours in the day. It's people say all the time, when do you put it down? So, well, you never put it down. The great thing about investing is it's life. Everything you do in life, whether it's me getting stuck in traffic today, there's a reason. Why is there so much traffic? Well, does that have information and content on the economy? Does that information content positive or negative on the economy? Maybe there's not. Maybe people should be at work and they're not at work. What are they doing? So it's taking information from around you in your life and, again, thinking about it, synthesizing it, and then using it in a way to craft new investment ideas. And so in my writing, I try to do three things. I try to do one, think about what has happened. So I do kind of the review of the markets. And they say, well, what are you spending time on that? It's the past. Well, we should think about why things happened in order to understand why it might happen in the future or why it might not happen in the future. So some time spent backward looking is important. Then there's the market outlook, and that's, okay, let's write down in print what you actually think is going to happen. Now, the danger of that is someone's actually going to read it and remember it, and they're going to tell you how stupid you were later when it doesn't happen. I'm like, well, guess what? I didn't expect to be right all the time. In fact, the funny thing about this business is there's so many people who will take what you wrote or what you tweeted or what you said, and they'll remember it, and they'll remember some these that you got wrong, and they'll throw it back at you like, well, that proves that you're not going to be right the next time. I'm like, oh, wait a second. Think about it. The very best investors in the world are right 56, 58% of the time, which means they're wrong, in the mid 40% of the time. The difference between great investors and bad investors is great investors are wrong way more than bad investors, because bad investors are so afraid of being wrong that they sit paralyzed and don't do anything. Mm-hmm. So they don't take as many swings. And it's like the Wayne Gretzky quote, you miss 100% of the shots you don't take. And so if you're always worried about being wrong, then you're not going to take the right risk-adjusted shots on goal. And eventually, you're not going to win as an investor. So that's the first two pieces. And the third piece in writing is I try to take some historical event or some philosophy. And what I do a lot is I'll take individuals who everybody thinks are really smart or brilliant, whether it's a great investor, like I've written about George Soros or Julian Robertson. I've written about great thinkers like Aristotle. I've written about all kinds of things like the creation of the Fed. Why was the Fed created? What happened before the Fed was created? Why does the economy function a certain way with the banking system the way it is today versus the way I think the banking system or the absence of the banking system will function in the future? So all these things come together to allow me, I think, to be a better investor because I have a respect for history and want to learn about it. I have this scientific approach to data gathering, data analysis, synthesis, hypothesis formation, hypothesis testing, and then just the constant willingness to put yourself out there, to take a stand, to have a conviction, and not be afraid of being wrong. I say all the time, I'm wrong all the time. I'll give you a great example. So I have a hyperbolic personality. You probably heard some of it on the podcast. And, I'll say things with force and with conviction. And so I give a lot of speeches and talks, and I was giving a speech, and my wife's only gone to one talk. She came to one speech in Vegas when we were on vacation. And at the end of it, she says, "You can't say things like that." I said, "What do you mean?" She says, "You say things so forcefully." I said, "Well, what's wrong with that?" She says, "Well, people will believe you." I'm like, well, that's actually kind of the idea. And so the point is that I don't worry that I'm going to be wrong probably half the time. And maybe if I'm really good, I'll be right a little more than half. But again, as Soros said, or Druckenmiller quoting Soros, it's not whether you're right or wrong in this business. It's how much money you make when you're right and how much money you lose when you're wrong. Mm-hmm. And if you can, again, let those winners run, and this, how I get from writing letters to Soros quotes, it all kind of ties together in that the reason I write the way I write, and the reason I do the research that I do, and the reason I look at historical figures, and the reason I look at great investors, and people like Sir John Templeton, with his timeless wisdom of it's not different this time, and everyone always says it's different this time, but it never is, because history rhymes and history repeats. And so if you take that wisdom from great investors over time and you apply that wisdom in your day-to-day process and philosophy about investing, I think you'll be more successful.
Mm-hmm. So I wanted to ask you about what you wrote you thought would be the surprises for 2019.
Yeah.
And we're about exactly halfway through the year. And I wanted to ask you which one of your predictions you think are most likely going to materialize and which ones you think are probably not going to.
Yeah, look, it's great. So if we kind of go through them, I think surprise number one was that interest rates would end up going down and that economic growth would be worse than people thought, and that I actually thought we would slip into global recession. If you look around the world, Europe arguably is in recession, Japan is in recession, US, I could argue, maybe is in recession. We'll see how the ISM comes out. Interest rates are definitely lower, right? Interest rates in Europe are negative, Japan's negative, US 10-year keeps falling. I think it broke 2% again. So I think I'm going to get that one right. So 2 was the cupboard is bare, kind of the cupboard is bare market. But that was that the central banks were going to try to save the day again, like they did in 2015. In 2015, we were in recession, right? We were on the borderline of a global recession, and China put $1 trillion of economic stimulus into the markets, and we averted recession, and oil prices recovered, and iron ore prices went up, and stock markets went up, and this time everyone thinks China's going to bail us out again, but I argue that the cupboard's bare. They don't have $1 trillion, and so it's going to be tough. So to that point, I think surprise 3 was you ain't seen nothing yet. So you ain't seen nothing yet basically says that if you think about last year, 2018, through September, everybody thought the markets were great. We're up double digits. And by the end of the year, markets were negative, global equity markets, that is, and bonds outperformed stocks. So I think that's how it's going to play out again. I think this is a bear market bounce that we've been experiencing here. And I think we're going to see pretty significant downside in the second half of the year, probably, in the fall. So that was that. So ain't seen nothing. It was just roller coaster ride, was getting warmed up. Mm-hmm. And remind me of 4 again.
Fangman stocks decline.
Oh, yes. Fangman turns to hangman. So what's really dangerous about any market is when breadth disappears. They say lack of breadth is death for bull markets. And if you take out the Fangman stocks, Facebook, Amazon, Netflix, Google, Microsoft, Apple, and NVIDIA, over the last 18 months, global markets are negative. So other than those 7 stocks, everything else is down. So that's a very narrow market, and one that I think people are going to be very unhappy if they own too much of those stocks in the future. So I think it's very similar to the CIMQ Cisco, Intel, Microsoft, Qualcomm back in 2000. For the next 19 years, you actually are underwater today. If you bought those 4 stocks in 2000, Microsoft's the only one that's above water, I think. So I think Fangman turns to Hangman. Then surprise 5 was currencies. Yep, currency. So look, I think the dollar has been dethroned as the global reserve currency, sole global reserve currency. I think the IMF SDR is an example of where we're headed, to a multipolar world. And I think the developed markets that are suffering from the killer Ds, bad demographics, too much debt and deflation, so the US, Europe, and the Japan are in a currency devaluation race to the bottom. So, you hear our president talk about how it's unfair that everyone else is weakening their currency and he wants his currency to be weak, even though we really don't, because we're not a manufacturing powerhouse like the rest of the world. But, c'est la vie. He doesn't really understand economics. But I do think that the dollar is going to end up being weak in the second half of the year, because it's our turn to take a little bite out of the currency bubble. And I think the yen's going to continue to go down. I think the euro continues to go down. I think the dollar continues to go down. And the things that do better will be emerging market currencies going forward.
Okay.
And next one was about oil.
Right.
I think oil is interesting in that oil is basically a tug of war between massive production in the U.S. and the willingness of Saudi and Russia to cut. They have, surprising to me actually, agreed to cut again or extend the cuts. So, my premise was that the massive production in the U.S. was going to create a glut in oil, which we have seen, yet oil prices have not corrected as much as they probably should. They're hanging around $60. I think they should be closer to the mid 40s given this level of production. But we'll see how that plays out. I think it's complicated by the fact of Trump and MBS's relationship. And, Saudi really needs a little higher price. They announced, I think this morning, that they're going to continue with the Aramco IPO. They need a higher oil price for that. So we'll see if they can manipulate the market up despite the shale production. I'm not confident that's going to happen. So I would think that we're more likely to see downside than upside in oil. And I think the next surprise about Japan.
Right.
I think Japan is the one I'm probably least excited about. I really thought that given how cheap Japanese stocks were and how easy it is to get that market to rally, which is just weaken the yen. And I thought that Kuroda-san was crazy enough to keep weakening the yen. But then I actually have a chart in my presentation that shows over the last 3 years, the yen has been flat. And that was shocking to me, given that, the 3 points of Abenomics are to weaken the yen, and that was number one. And so I don't think they're going to be able to weaken the yen. I think it's their turn to maybe be stronger because of fear about the global marketplace, and it's a safe haven currency. So I think I'm going to end up being wrong about Japan. Europe, I said it might be so bad that it's good. It's a great line. Mostly about emerging markets, but it applies to other markets, that you make the most money when things go from truly awful to merely bad. And it is truly awful in Europe, particularly European banking. And yet now we're starting to see some recovery. Deutsche Bank turned up a little bit. Some of the Italian banks turned up a little bit. So I said it was either they were all going to zero or it was going to end up being a pretty interesting place. So I do think there are some bargains in Europe. So maybe that will come true. But I think it's still a non-zero probability that a bunch of the European banks are still over-levered and in trouble. Then emerging markets was kind of go your own way. And, most people think in old terms that if the U.S. sneezes, the rest of the world catches cold. And that's, 20, 30 years ago. That's not the case anymore. And what people are missing, particularly in emerging markets, particularly in China, is it used to be all about made in China. So it was about exporting your labor and your pollution to China and taking cheap goods back and having a big current account challenge in China. Now it's all about made for China. China is going to be the greatest consumer market in the world over the next 20 years. And as they transition from manufacturing to a consumer economy. And so I think emerging markets are going to buck the trend, and they're very, very cheap. And, when you buy assets at cheap prices with good margin of safety, that's good. So I think that one's going to work. But, it didn't look good in the first half of the year because people still thought the Fed was going to raise rates. Now that it appears Fed is not, emerging markets should do well. Then the last one was about commodities. Actually, The second to last one was about commodities. Commodities is interesting. They are the cheapest they've ever been relative to paper assets. So I say hard assets are better than paper assets. The challenge is there's just so much productive capacity around the world that it is dampening prices. So I think that one could end up being wrong too. I thought that commodity prices were going to rally. I thought there'd be some flashes of inflation. Inflation is nowhere to be seen. In fact, we're definitely locked in deflation. So if we're locked in deflation, then I think commodity prices will struggle unless the dollar really takes a crater. And if Trump really gets nervous about the economy, he might crater the dollar. So we'll see how that goes. And then the last one was about Bitcoin. Bitcoin's back, tell a friend. And, if you would have told people at the beginning of the year that Bitcoin would be the best performing asset, they would have said you were crazy, which is what I said. And people said I was crazy. But here we are up, 180% and way better than most assets. Now, that's also the law of small numbers. When a market craters 84%, buying assets that are down 84% has usually been a good strategy historically. And we think the parabolic up moves are always then punctuated by these big downdrafts. But it's a 4-year cycle, and it occurs around this halvening concept of, reducing the mining reward by half. So the price has to adjust so the miners stay break even. And so I think that puts structural upward pressure on prices of Bitcoin. Adoption rates are at new all-time highs. Number of wallets are at new all-time highs. And so crypto is, if you think about what cryptocurrency is, in particular what Bitcoin is, it's just an evolution of computing power. So 54 is the mainframe, 68 was the microchip, 82 was the personal computer, 96 was the internet, 2010 was the mobile net, and 2024 is what I call the trust net, or the internet of value. And I think every major business eventually will run on blockchain, just like we started with DOS for computers, then we had iOS and Android for supercomputers in our hand. Don't call them phones because no one talks on them. And then blockchain will run businesses in the future. So that's a lot quickly. I apologize for talking fast, but that was fun.
This is great. And I would encourage everyone who's listening to actually go read your letters because they're very well thought out. And yes, you talk about many different topics and thinkers. And it was a lot of fun for me to do the research for this interview. And Mark, while I have the CIO of Morgan Creek on the phone, I wanted to ask the last two questions. One is your point number 9 about emerging markets. And this is something that I've thought about for quite some time, and I would love to hear your thought on it. For example, if we talk about Brazil, which I was born and raised there, so I have a personal interest in that country, it looks like it's very difficult. So your success in investing in Brazil, for example, is very much dependent on your entry and exit points if you're an international investors, because the currency is so volatile. And if you want to invest in private investments, so private equity, venture, real estate, your timing has to be spot on. And the structure of a private equity fund is not the best if you want to time the market because you have a set number of years that you're getting in and getting out. So how do you think about, for example, if you were to invest in Brazil, how would you think about putting your money there?
Boy, really number of really important points and questions and really universal in the way you think about investing in international private equity around the world. So you should always think about your home currency risk, and you should think about it relative to others. In Brazil specifically, it's very interesting in that, for years, Brazil had a structural current account problem and therefore a real headwind for the currency. They have solved that current account problem. So there is some argument to say that headwind of the real is going to turn into a tailwind for U.S. investors or European investors. So that would argue for maybe overweighting Brazil here. You also have some structural changes in politics in the sense that, they had the rampant corruption. They kind of cleaned it up, not completely, but they've done a pretty good job there. And so there's some positives there. And then you had essentially a depression, and now we're on the other side of that. So again, another tailwind. So as we think about it, I agree with your point completely on the challenges of private investing in those countries is being locked up for a certain amount of time with people who are incented not to be reactive to the changes in the currency or the opportunity,
Absolutely.
but to hold your money and charge you fees for 10 years. So we have tended to be more overweight in the public markets because you can change your time horizon of investment. And the other thing in private investing, it has been hard to find really good talent in private investing in Brazil. And I have a theory on it, which I don't know if it's right or not, but my theory is that the banking industry was never quite as robust a training ground for private equity investors the way the U.S. and European markets were. So that's just one thesis. But there have been some parachute investors, like Tiger Global has done some really nice investments in Brazil in technology. And so there have been some opportunities, but in many cases, the best investments were ones where we didn't put the capital into the real. We just kept it offshore, either in Cayman or Singapore structures. We do that a lot in China too, where we don't want to take the renminbi risk, but we want the company growth opportunity. So we just keep the capital in dollars in one of these offshore structures like Mauritius. But you bring up a lot of interesting points about Brazil specifically and about international investing in private.
Yeah, well, great. Thank you. Thank you for that. That's very good. And last question from my side is, you talked about crypto. If I were to go to my investment committee next week, and we don't invest in crypto, by the way, and I think I can say that. If I were to go to them and convince them that our allocation to crypto should not be zero, what would you advise me to tell them?
Yep. Yeah, it's great. And well, our whole thing is get off zero. So hashtag get off zero. And what people need to know is that 10 years from now, when we look back, I think it's going to be deemed fiduciarily improper to have zero allocation. The same way that 20 years ago, putting money in hedge funds was deemed irresponsible for institutional investors. And then it was venture capital and private equity and, private real estate. So all of these things that were alternative at one point eventually became mainstream. And so today, I think the way you go to a committee is you say, look, at its core, cryptocurrency is a use case of blockchain technology. Blockchain technology is an evolution of this technological kind of operating system for computing power. And the way to invest in any technological evolution is in the picks and shovels, in the infrastructure. So the way we've convinced other institutional investors, whether it's pension funds, the first two public pension funds, or endowments and foundations to invest with us, is to say, look, you've always invested in technology. You've always invested in innovation. This is an example of both of that. And so take a small amount of capital, so 1%, 2%, and invest in the infrastructure around this emerging technology. So invest in the blockchain technology, invest in exchanges, in protocols, in software, in tools, in data. And if we think about the evolution of financial services, right, we went from analog technology, right? Every stock, bond, currency, and commodity is a paper certificate. Then we went electronic. So now we have QSIPs. They're representatives of those paper certificates that sit at DTCC. But ultimately, we're going to have digital assets. And digital assets, we won't need the paper anymore. We'll have pure digital ownership. That digital ownership will be represented in true digital form. But what blockchain technology does, and what cryptocurrencies do, is it solved something called the double spend problem. And if you think about file sharing, you have a computer, and I have a computer, you have a song, I have a song, we want to share songs. Well, I could make a copy of a song and send it to you. Well, you don't know if you have the original or the copy. Well, with money or value, you really care. You want the original, not the copy. And so what blockchain technology does is it creates this triple entry accounting system, back to the Medici's dual entry accounting, which replaced the single entry accounting in the 1860s. And the dual entry accounting requires a bank, a trusted third party. What triple entry accounting does, or blockchain technology does, it allows you and I to exchange something of value without a trusted third party. So the reason a fiduciary has got to embrace this and say get off zero is that as we migrate down the path of this technological evolution, all of commerce, all things of value, everything's going to move to true digital ownership. And the machines, think about it, you're going to sit in your car, it's going to pull up to the charging station, it's going to charge. You're not going to get out and put a card in anymore. The car is actually going to pay the charging station. Well, it's not going to do that with fiat currency. It's going to do it with cryptocurrency. And so a blockchain technology is really the accounting system. Cryptocurrency is one use case. And it's not about speculating in any one cryptocurrency that's important. It's about embracing this innovation in technology and taking advantage of the opportunity that comes around every 14 years. I always say why it's 14 years, I don't really know. It has something to do with kind of the creative class. But when these technological evolutions occur, whether it was the mainframe, microchip, personal computer, internet, mobile net, and now the trust net or the internet of value, there's this period of time around this technological evolution where the opportunity set is so great for investors that if you miss it, you're going to feel badly later and you're going to have, suboptimal returns. And again, as fiduciaries, we're supposed to build a balanced portfolio, taking advantage of innovation, technological innovation over time, and build a portfolio in a diversified way that manages risk. So the last reason I would say to embrace this is I've been doing this a long time. I say I got white hair to prove it, is I've never seen an asset that actually delivers on the promise of asymmetric return upside and low correlation. Usually if things have good return upside, they're highly correlated, and those correlations rise in times of stress. Interestingly enough, crypto actually has about 0.15, 15% correlation, and it actually falls in times of stress. So it's a wonderful diversifying asset for a diversified portfolio. And the asymmetry of it means you don't have to put a lot to provide a hedge against ultimate chaos in the fiat currency system or technological obsolescence of other things in your portfolio. So a small allocation provides a lot of benefit. And just like we invest in venture capital or buyouts or energy or commodities as diversifying assets, this is what you want to do it for.
Well, Mark, thank you. This has been great. Certainly, you've given me a lot to think about, and I hope the listeners have learned a lot from this as well. Thank you for taking a lot of your time. You said you're at the beach right now, so I apologize for keeping you from the beach, but I do appreciate you taking the time, so thank you.
No, I appreciate the invitation, and as I said, I love the fact that you really prepared in a serious way for this, had lots of great questions, and as I said, I could have talked all afternoon just because there's nothing more fun than having a really good conversation with someone who has really prepped and has lots of leading questions to take us down paths that are going to be useful to the listener. So thanks for having me. Thanks for doing this, and maybe we can do it again sometime.
Absolutely. Great. Thank you.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.